Hello and welcome to Real Talk Economics, the July edition. My name is Markus Kuger and I'm the Chief Economic Advisor at Bakering. We are a global accounts receivables management company. It's the hottest day of the year here in Germany, 40 degrees, hence I'm wearing a t-shirt. And we are now also in the second half of 2025. So I think it is a good moment to reflect and look back at the first half of the year. What has gone well? Probably not that much. And I also think it is a good moment to look at Q3 and Q4. What's going to happen in the second half of 2025? And positively, some of the data series at the moment, they are improving, which bodes well for the next few months. But problematically, despite these recent improvements, there are still a few issues. The outlook continues to be clouded by geopolitical trends, by meager growth rates, and credit risk, payments performance, business failures is also rather problematic and will continue to do so for the foreseeable future. The topics that I want to cover today, macroeconomic conditions at the start, a lot of charts and tables. I will then move on to geopolitical trends, and then we look at business failures and payments performance information as well. The special topic today is France. For those of you that tuned in 2 months ago, I talked about Germany, my home country, also the biggest country in the EU. And France is the second biggest country in the EU, and it's also facing severe problems. Some of them are identical to Germany's, but others are unique. And we will talk about that topic towards the end of today's presentation. If you're watching this recording on the Bakering homepage, it actually does not include the Q&A session because we are uploading the dry run recording. If you are interested in the Q&A session, in interaction with me, and I'd strongly encourage you to do so, I'd invite you to join the August Real Talk Economics session, which will take place on 6th of August, 12:30 UK time. As always, first Wednesday of the month is Real Talk Economics session. So let's look at macroeconomics first, and let's start with high frequency indicators, such as exchange rates. And here we can see the US dollar exchange rate against the euro. And in fact, the dollar has depreciated immensely against the euro over the past 6 months. In fact, the euro had the dollar had its worst start to the year since 1973. And that's a bit surprising because markets had actually been fairly upbeat about the dollar since November. In November, Donald Trump won the election and the dollar appreciated, as you can see in this chart. But especially since March, April, investors have lost confidence. The dollar has moved lower and is now actually on its weakest reading in 2.5 years against the euro. And it's not only against the euro, the dollar has also depreciated against other currencies, such as the British pound. Why is that? Well, that has to do with the policy making in the US. Investors are concerned about the course of especially fiscal policy in the US. This new bill that's currently in the US Congress will lead to an immense fiscal deficit, and that is putting some downward pressure on the dollar. Looking at stock markets, we can see that this is the S&P 500, by the way, so US shares, and in a year-on-year comparison, they're up by 14%. But when we look at its performance since the start of the year, since February, it isn't as good. In fact, we're roughly back to where we were at the beginning of the year. But then Donald Trump made these tariff announcements in April, and that had a massive consequence on share prices around the globe, but also in the US, because the tariffs haven't been brought in yet. Investors have become a bit more upbeat, and the S&P 500 has recovered, has regained some ground, and as said, we're back to where we were before February. When we look at Europe, different performance, quite unusual performance, because normally the American stock markets outperforms the European stock market. Here we can see the DAX, the 30 biggest companies in Germany, stock listed companies, and the DAX is actually up by 30% year on year. You can also see that drop in April following the tariff announcements, but overall the DAX has performed better over the past 12 months, and it has also performed better year to date. The FTSE 100, so British companies, only up by 7%, a bit of an outlier here. Moving on to consumer confidence, and we start with the US. And you can see by looking at this chart that consumer sentiment in the US was hit heavily in the first few months of 2025. Consumers have become more pessimistic, and positively, the latest data point for May shows a stabilization, but it's stabilizing on this much lower level, which is, I'm not sure if that's good or bad. Depends if you're a pessimist or an optimist. I think it's evident that American households are less optimistic at the moment than they were 3 months ago, 4 months ago, 5 months ago. And that's bad news for the global economy, because US consumption is a very, very important pillar of global economic performance. Let's look at the EU. Similar trend here. Consumer confidence peaked in Q3 last year. In fact, we were almost back to the long-term average, but between September and April, consumer confidence in the EU and in the Eurozone as well has deteriorated. Households were becoming more reluctant to spend, which is bad news. But the good news here is that in May, we've actually seen an improvement. Now we have to wait for the June data point to see if this improvement has continued, but at least the last data point was encouraging. And we can see a very similar development here in the UK. In the UK, consumer confidence dipped around August, September last year. Since then, it has more or less moved sideways. And in May, it has improved, but you can also see that it has improved from -23 to -20, which means there are still more pessimistic households than there are optimistic households. So from the consumer side, globally, we are seeing some improvements, but we're seeing an improvement from a fairly low level. So the likelihood that domestic consumption, household spending will drive growth in the second half of the year has increased, but it's still not looking good compared with a year ago or so. Let's look at business confidence. And here we're looking at the Global Business Confidence, a publication from S&P Global. This is a PMI, a Purchasing Managers Index information. And that means that the range of this index is between 0 and 100. 0 is the worst reading, 100 is the best reading, 50 is the neutral line. Readings above 50 are good, readings below 50 are bad. And we're looking at the 3 most important sub-indices here. The blue bar is the output sub-index, the orange bar is the new order index, and purple is the employment index. If the bar goes to the right, it's above 50. If the bar goes to the left, it's below 50. And again, below 50 readings are negative. When we look at this table, we can see that, generally speaking, service sector companies do better than manufacturing companies. All service sectors reported output growth in May. There was one exception, that was tourism, but generally speaking, service sector output is growing, especially in insurance, telecoms, and the financial sector. The blue-collar industries, unfortunately, they tend to struggle, especially in the very traditional blue-collar industries. Look at metals and mining. The output there has been plummeting, more or less, has been falling by the fastest pace in almost 2 years. And when we look at employment, we can also see a drop in all manufacturing sectors, with the exception of the chemical industries. When we analyze new order inflow, we can see that 8 of the 21 sectors that are covered in this publication, they reported a drop in new orders, which isn't good for the sales pipeline, because if you're not getting orders in now, you have nothing to sell in 3 months' time, 6 months' time. And there's also another issue, and you can't see that from the chart because it is a sub-index that isn't plotted here. There are sub-indices called output prices and input costs. So input costs, basically the cost that companies have to pay when they purchase labor and materials, and output costs are effectively sales prices. And for the first time in 2.5 years, both output and input costs increased in all 21 sectors. The problem here is that only in the chemical sector, output prices increased quicker than input prices. In other words, in 20 out of 21 sectors, profit margins became more stressed, became more squeezed, and that doesn't bode well for credit risk. Let's look at inflation. And here we can see inflation in the UK. Inflation had been on an upward trend for quite some time. Between September and April, inflation had increased, but the latest data point for May has shown a marginal drop. CPI, consumer price inflation, has fallen from 3.5 to 3.4%, and CPIH, the H stands for housing costs, has also come down, has dropped from 4.1 to 4.0%. What hasn't changed is that inflation in the UK continues to be driven by the service sector. Maybe not as much as it was a month ago or 2 months ago. The gap is certainly narrowing, but service sector inflation still stands at 5.3%, and goods inflation stands at 2%. So there is a massive gap between services and goods, and in the UK it is smaller than in the Eurozone. In the Eurozone, this gap between service sector inflation and goods inflation is bigger. What's driving UK inflation? Well, services, of course, I've already said that, but within services, it's education, housing and household services, health and communication as well, that has seen sizable increases in May, and we've seen that since the start of the year. The UK is a bit of an outlier at the moment. UK inflation is higher than in the EU and in the US. In the EU, inflation stands at 1.9%. So that is just below the 2% target the European Central Bank has. 2%, by the way, is also the inflation target the Bank of England has. In the US, inflation went up last month. And that was an eagerly awaited data release, because for the first time, the impact of the tariffs that the Trump administration had brought in became visible. So you might have not realized that the Trump administration has actually brought in certain tariffs. So imports from Canada, imports from Mexico, they're facing higher tariffs. There are tariffs in the aluminum and steel sector. There are tariffs in the car industry. So trade barriers went up, and that increased the price of imports. And because the price of imports in the US went up, that was expected to have an effect on inflation. And it had an effect on inflation, but it had a very small effect on inflation. Inflation in the US increased from 2.3 to 2.4%. So that is good news, because it should enable the Federal Reserve to cut rates in the second half of the year. When we look at the UK, I said UK inflation is somewhat elevated, 3.5%, 4%, depending on the inflation measure you're looking at. That is too high, and problematically, the Bank of England expects inflation to peak at around 3.7% in Q3. It will come down after that, but the 2% target will not be hit before 2027. Next chapter, interest rates, closely connected to inflation, of course. And here on the left-hand side, you can see the interest rate on new loans to SMEs in the UK. If you remember the slide, the previous slide, inflation slide, actually, let's move back so you can see it. You can see that inflation peaked in 2022. Since then, it had been on a downward trend. Yes, there was a bit of an uptick in Q3 and Q4 and Q1 as well. But compared with 2022, the situation looks okay. We're nowhere near these double-digit inflation rates that we've seen a few years ago. So that's good news. And because inflation has come down, central banks around the globe have cut rates. When we look at the UK, the key policy rate in the UK decreased from 5.25 to 4.25% over the last 12 months. In the Eurozone, these cuts were even more aggressive. Inflation is more stable, lower in the Eurozone. And that's why the ECB has cut rates from 3.75 to 2%. The good news is that interest rates will continue to come down in the second half of the year, even in the UK, despite inflation overshooting the target at the moment. Markets are expecting a cut to 3.75 to 4%. So somewhere between 25 to 50 basis point interest rate reduction is priced in by markets for the second half of the year. I think that is a fair assumption. The economy isn't doing well, and that will entice the Bank of England to cut rates. The problem, and that's why I include this chart here on the left-hand side, is that despite the recent cuts, interest rates are still very, very high. And if you have joined last month Real Talk Economic Session, the May edition, the April edition, this is something that I continue to say because I think it is very important. Interest rates are coming down, yes, but they're coming down from a super high level. The interest rate level seen in 2023 and 2024 was a very high level. In fact, the highest level since the global financial crisis. And we're seeing improvements now, but we're still on a very, very elevated level, which means that money is quite expensive, and that has a negative impact on credit risk. There's another problem, and that is lending conditions. Central banks around the globe, they tend to publish quarterly publications that look at lending conditions. In the UK, this is called the Credit Conditions Index, and the latest one was published in April. The next one is due in a few weeks, so I'm looking forward to analyzing that. But the problem at the moment is that British banks expect more corporate failures in the next few months. And that probably means that lending conditions have tightened and will continue to tighten. So not only is the overall amount of interest an issue, getting access to credit is a problem as well. And that is having negative repercussions on credit risk. I tend to be very negative in my presentations. I'm well aware of that. That could have something to do with my German background. I'm also an economist. I don't think we are known for being overly optimistic, but even I have to admit there are a few pockets of the economy that look okay, and the labor market is one of them. But even there, I have to admit, or I have to say that things are starting to darken a bit. And we can clearly see that by looking at job vacancies, top left here. The number of job vacancies dropped significantly during the COVID lockdowns, not a surprise. Then the economy reopened and the number of job vacancies soared to a new all-time high. At some stage in 2022 or 2023, I can't remember exactly, there were 1.3 million vacant jobs in the UK. And the UK isn't an outlier here. We would have seen a very similar development in continental Europe as well. So 1.3 million job vacancies, record high in the UK. But for the past 2 years, 3 years, the number of job vacancies has been falling. And the current reading of 761,000 job vacancies is actually the lowest reading since COVID. So we're now on a job vacancy figure that is below the early 2020 figure. Employment, top right, dropped during COVID. A lot of people left the labor market then, and they haven't returned. Employment rate stands at 75%. That's below the pre-COVID reading, but it is up when we compare it with a decade ago or so. So I leave it to you to decide whether that's good or bad, but we have certainly seen an issue with employment over the past few years. Unemployment has moved lower before COVID. Then COVID came, lockdowns were implemented. Of course, that had an impact on the unemployment rate, but positively, that only lasted for a few months or quarters, and the number of unemployed people dropped. But for the past 2 years, it has been creeping upwards again. The unemployment rate in the UK at the moment, 4.5%. The good news is that is much lower than in the EU. In the EU, unemployment stands at 6%. And the good news is also that 4.5% isn't a lot. In fact, it is very close to what us economists would consider full employment being reached. Full employment is defined as an unemployment rate of around 3%. So in the UK, yes, deterioration when we look at unemployment, but yeah, still looking okay. The most erratic chart here is the one at the bottom right, which is real wage growth. Real wage growth is a combination of nominal wage growth minus the inflation rate. And because inflation was fairly erratic, we're leading to spikes and troughs. And at the same time, nominal wage growth was also very erratic because COVID changed the market power of employees. At the moment, we have a real wage growth of 1.8 or 1.7%, depending if you include bonuses or not. And that figure is actually a good figure. If you ignore COVID, because COVID distorted everything, this is actually the best reading in 10 years. Best reading coming from a household angle there, not from a company angle. Of course, for companies, that's not good news. If real wage growth is high, that has negative repercussions on profit margins. But for households, it's obviously good news because it increases their spending power. And household spending power suffered severely during that cost of living crisis. You can see a significant drop in real wage growth in 2022 and 2023. So labor market still looking okay, but not as good as 6 months ago. That's the story I wanted to get across to you here. Let's look at the most important economic indicator there is, and that is real GDP growth. And here we can see figures from the IMF's World Economic Outlook from April. This is a quarterly publication. So an update is due in July. And let's start with global growth. Left-hand side, that light blue box. And global growth this year, 2.8%. That's the current IMF forecast. And that figure is problematic because of several reasons. First problem, it's down from last year. Look at 2024, 3.3% growth last year. Now deceleration to 2.8%. So that's the first problem. The second problem is that it's slowing down from an already disappointing level. So 3.3% growth last year wasn't good. Global growth tends to be higher. That figure in 2024 was rather disappointing, and it will now become even more disappointing. And the biggest problem in my eyes is that if you had looked at the January version of this World Economic Outlook forecast, you would have seen that global growth was expected to come in at 3.2%. So within 3 months, the IMF has downgraded its growth forecast from 3.2 to 2.8. And that was caused by the tariff announcements that Donald Trump had made in spring. Of course, his tariffs haven't been brought in yet, we have to say. So I'm curious to see the July edition. I think we will probably see some upward revisions to growth again, but it's fair to say that even with upward revisions, 2025 will not be a good year from a macroeconomic perspective. The biggest downgrades between January and April were actually occurred to the US. In the US, growth was expected to come in at 2.7%. That was the January forecast. And now that growth rate has come down to 1.8, from 2.7 to 1.8 in a few months. That is quite dramatic. I've been working as an economist for more than 15 years, and I haven't seen these changes very often if you ignore COVID, if you ignore war-hit countries like Ukraine. But such a severe downgrade is fairly unique. But it wasn't only the US that has seen downward revisions. China, for example, was downgraded from 4.6 to 4%, the euro area from 1.2 to 0.8, and in the UK, the growth forecast was revised downwards from 1.7 to 1.2%. So downgrades across the board. I think we will see some upgrades in the July version, but again, even with some cosmetic changes, 2025 will not be a good year. Which brings us to politics, and that is closely connected to the previous slide, because these GDP growth forecasts, they were largely revised downwards because of geopolitical trends. And one of the major topics at the moment, you can see here, this is the Economic Policy Uncertainty Index. It basically tracks certain keywords that measure economic uncertainty in big publications around the globe. And you can see that we had a spike during COVID, then things improved. But since the re-election of Donald Trump in late 2024, this Economic Policy Uncertainty Index has been rising very quickly, and it hasn't come down yet. I think that in the next, with the next data point, or the second next data point, we will see a moderation. Economic policy uncertainty probably isn't as high as it was during spring, but as you can see, we are on an all-time high. So even with some improvements, it is still a very complicated environment to do business in. And we can also see that by looking at the Trade Policy Uncertainty Index, which follows a similar methodology. We're tracking certain keywords here. There was a spike during COVID. Of course, there were lockdowns in place, and it was fairly tricky to trade with foreign countries. But then we've seen an improvement. And yeah, then Donald Trump was reelected, and this index skyrocketed. The latest data point is June 29th of June. And you can see that compared with April, things look a bit better. But that's just when we compare it against April. If we compare it with 2023 or even 2020, COVID hit 2020, Trade Policy Uncertainty Index is still very elevated. Shipping costs were an issue last month. Shipping costs skyrocketed as well, especially on the China to US routes. But positively, that has changed again. Why has it changed? Well, things changed last month because a lot of American companies, they were ordering a lot of input goods from China. The tariffs weren't brought in, but business leaders in the US are not convinced that this will last. So they still assume that at some stage the Trump administration will increase tariffs on Chinese imports. Hence, they're trying to get as many input products into the US, and that caused an immense spike in demand for shipping containers, and that had an impact on prices. But now that trend is reversing. These goods have been ordered. Maybe containers also became too expensive, and companies are adopting a wait-and-see approach at the moment. So good news on the shipping cost front, because shipping costs obviously also impact on inflation rates. But we have seen a moderation over the past few weeks. This is the oil price, which can be used for measuring geopolitical risks as well. Of course, there are supply and demand issues as well, but I included it to show you the effect of the war in Iran, or the aerial attacks on Iranian nuclear sites over the past few weeks. We can also see the effect of the tariff announcements in early April. The oil price plummeted because the likelihood of a global recession increased, and that had an impact on demand for oil. And then we had this temporary spike over the past 2 to 3 weeks. First, Israel attacked Iran, then the Americans joined in. And once these attacks were completed, the conflict, I wouldn't say it's over, but at least there's a ceasefire in place. And you can see that the oil price has fallen back to a more moderate level. When we compare it year on year, the oil price, and we're looking at Brent here, so North Sea oil, that is down by around 22% year on year. And that is also good news for inflation as well, because oil remains to be a driver for global inflation rates. Maybe not to a degree, or not, certainly not to a degree that it was in the 1970s and 1980s. The world has become more independent, not as reliant on oil as it was 50 years ago, but it is still a key factor for the global inflation rate. And as said, oil prices are down by around 22% year on year. Which brings us to credit risk. And let's start with business failures in Europe, because there have been some developments in England and Wales, and unfortunately these developments aren't positive developments. Last year, England and Wales has seen a drop in business failures. Figures decreased by 5%. So that was good news. The bad news was that, well, they decreased from a 30-year high. The number of business failures in 2023 was the highest in 30 years. But the more problematic bit is that when you look at monthly data for 2025, you can see that in January to May is the latest available data point, figures have started to increase again. They were up by almost 4% year on year in the first 5 months of 2025. So that is worrying news for credit risk in the UK, or in England and Wales. To be fair, this chart doesn't include Northern Ireland and Scotland, but it's clear that the journey is going in the wrong direction, unfortunately. In the EU, different story. The EU has seen an increase in business failures last year, up by 4%. The three largest economies, Germany, France, Italy, they've all seen triple-digit increases. But as you can see from the chart, you need to look at the yellow line here. By the way, the blue one is business registrations, but the yellow one is bankruptcy declarations. And you can see that this yellow line peaks in Q3, and it has been moving lower in Q4, and it has also fallen in Q1 2025. It came down by 1.5% year on year. If we change the angle a bit, make this a bit more global, we can use the Allianz Trade Global Insolvency Index. That's a publication that gets produced several times a year. And as said, figures went up in 2023. Globally, figures also increased in 2024. In fact, they rose by around 10%. And there is another problem that didn't only increase against 2023. The current readings are also above the pre-COVID levels of bankruptcies. When we compare the current reading against the 2016 to 2019 average, we can see that the global insolvency index that Allianz Trade is calculating is actually up by around 10 to 15%. So high level of credit risk, not only compared with last year, not only compared with the COVID years, also compared with the 2016 to 2019 period. What's in store for the second half of the year and moving into 2026? Well, conflicted, I'd say. On the one hand, interest rates will come down. That's certainly good news, but you remember the interest rate chart. Interest rates, despite that recent improvement, are still very high. So the cost of credit is elevated compared with a few years ago, and accessing credit is also complicated because of the tighter lending conditions. So I'd expect a further increase in the number of business failures this year. And that's also in line with what Allianz Trade's forecasting. They're expecting a 6% increase globally, with Brazil and Germany being hit the hardest. That's the top right of that chart. Basically, that means that in Brazil and in Germany, insolvency levels are already high. There are 15% above the 2016 to 2019 average. And from that already elevated level, Allianz Trade is forecasting another 10%, at least 10% increase. So that is rather problematic for Brazil and Germany. But as you can see, Italy, the US, Switzerland, New Zealand, Morocco, there are also countries that need to be monitored closely. So of course, this is traffic light coded. Red is bad, green is good. And the further you are towards the top right corner, the riskier it gets. Looking at payments performance here, this is the average payment delay in days in Q1 2023. This is data from Dun & Bradstreet, my old employer. And yeah, I've been working with the data for all my professional life, basically. And when we look at the 2024 performance, we actually won't see a lot of change, at least for the European average. The European average stood at 12.1 days in early 2024, and it moved to 12.2 days by December. So a very, very small deterioration in payments performance, B2B payments performance, that is, in Europe last year, according to DNB data. And again, this is, or maybe I haven't said it actually, this is measuring the average payment delay in days beyond agreed terms. So it's not factoring the payment terms in a country. So in Germany, 15 days, 30 days. In Spain and Italy, probably more, 60 days, 90 days, 120 days, depending on the sector you're operating in. So that isn't included in here. This solely measures the average payment delay in days beyond agreed terms. As said, last year, minor deterioration, nothing to be too worried about. But when we look at data for Q1, we actually see a fairly sizable drop. Unfortunately, delays in Europe increased from 12.2 days to now 12.7 days. And one of the worst performers in Q1 was actually the UK. Payment delays there went up from 10.8 to 12.2 days. But we also have to keep in mind that the UK was one of the best performers last year. Actually, the UK has had a very good 2024 and 2023 as well. And now it's losing some of these gains that it has made over the past 2 years. France is a country to watch, and we will come to that in more detail in the next chapter. But just the stats here, payment delays in France have increased from 12.6 days before COVID to 17.7 days now. So within 5 years, payment delays increased by 5 days, according to the DNB data, which is a very, very quick deterioration. As said, I've been working with that data for 15 years or so, and I haven't seen anything similar. And it's not only visible in DNB data, it's also something that we at Bakering are seeing in the demand for our services, collecting overdue invoices in France. That has gone up immensely. We had to hire 4 French-speaking credit managers recently because there's so much demand for that. So if you are operating in France, this is certainly a worrying country, which brings us to the next chapter. And I try to be funny. And as you know, I'm German, so we're not really known for our humor. But I've been learning French for 3 years now on Duolingo, and I had learned French in school. So I thought I should make an attempt on a joke using French language. So I called this chapter France, Liberté, Égalité, Payment Delay, because as you can see, payment delays are becoming an issue in France. But this is not the only problem the country is facing. And let's start with politics. And here you can see the seat distribution on the left-hand side of the French National Assembly. They had early elections last year following the European elections. And as you can see, Parliament is roughly split into 3 equally sized camps. There is the far left, the center, and the far right. And there's no clear majority, which has led to a very high degree of political instability. In fact, the country had 4 prime ministers since the start of last year. That's fairly unprecedented. And it basically means that the government's weak. It's a minority government led by a centrist. and they constantly need to cut deals either with the far left or the far right. And of course, these parties are not really interested in implementing painful reforms. And that has caused issues for the country's fiscal deficit as well. Government debt has become a problem in France. That's not a recent development. That is something that has been going on for several decades. At the moment, the government debt stock stands at 118% of GDP, and that's actually the highest reading since World War II. That was driven by the COVID response, that was driven by the financial crisis response. Now that is to a certain degree driven by military spending. But yeah, government debt in France is very high. Markets have become a bit more nervous. The country has been downgraded by big rating agencies. The yield on French government debt has gone up. In fact, last year, I think it was, that the 10-year bond yield on a French bond was higher than Greece had to pay. And yeah, that's a very worrying trend. You can see from the chart below, the fiscal deficit in France is also very, very high, much higher than in other Eurozone countries and the Eurozone average as well. So the country at the moment is not able to implement painful but much needed reforms. And that doesn't bode well for the future. When we look at the economic side of things, they are not looking good either. Consumer confidence is at the lowest reading since late 2023 at the moment. In the construction sector, the PMI stands at 43 points. Remember, readings below 50 are bad. It means that the sector is contracting. Construction sector PMI is on the worst reading in 3 months. In the service sector, by far the biggest sector of the economy, that PMI is a bit higher, but it's still below 50. It's on 48.7 points. In manufacturing, the corresponding PMI is on the lowest reading in 4 months and also below the neutral 50 points threshold. When we look at the real GDP growth forecast for this year, the IMF is currently predicting growth of 0.6%, better than in Germany, but still a very, very disappointing growth rate. And it is also down from the 1.1% recorded last year. Positively, inflation is under control. Inflation in France is expected to come in at 1.3%, so comfortably below that 2% target the ECB has. Unemployment is also an issue in France. First of all, it is already higher than the EU average. I've mentioned that before. The EU average at the moment is 5.9%. It's the lowest reading ever recorded in the EU, but in France, unemployment is higher, 7.4%, and from 7.4%, unemployment is also expected to increase to 7.8% in late 2025. So maybe with the exception of inflation, none of the macroeconomic indicators in France looks promising at the moment. And that brings us to the credit risk section of my France presentation. And for those of you that tuned in last month, you will remember this slide. This is from Dun & Bradstreet's latest global payment study. 39 countries, broken down by sectors as well. And here we can see payments performance in Southern Europe. We are looking at the share of prompt payments out of total payments, which is the blue bar. And we are also looking at the share of payments that were made 90 or more days late. And again, that's as a fraction of total payments in a country. So in other words, blue is good, orange is bad. Look at Spain, 45%, 46% prompt payments by Southern European standards, not that bad. Share of payments that are made 90 days late stands at 6%. And maybe that looks okay when we compare it against Romania or Greece, but it doesn't look good when we compare it to Northern European countries, which is what we're doing now here. So remember, in France, share of prompt payments below 50 and share of payments that were made 90 or more days late stood at 6%. So you can't find a single country in Northern Europe where the share of payments that was made 90 or more days late exceeds 5%. And that's actually Russia. War hit Russia, has a better payments performance than France, according to data from Dun & Bradstreet. And 46% prompt payments is also rather disappointing. It would put France on the third worst position here. Only Belgium and Luxembourg pay slower when we measure it by prompt payments. So in other words, payments performance in France has been problematic. I've told you 5 minutes ago, the average payment delay has gone up by around 5 days over the past 5 years since COVID. And this is mirrored by the share of prompt payments, and this is also mirrored by the share of payments that are made 90 or more days late. Here on this chart, we can analyze sectoral payments performance in France, and same logic here. Blue is prompt payments, and that, not sure what color it is, purple is the share of payments that are 90 or more days late. And you can see significant changes between sectors, and that's not surprising. The DNB Global Payment Study includes this information for, I think, all, maybe most, maybe there are a few exceptions, but this chart exists for 35, maybe even 39 countries. I can't remember. So have a look. If you can't find it, send me a message on LinkedIn. And yeah, as you can see, there are sectors like construction where the share of prompt payments is fairly good, but then transport and distribution, 1 in 3 invoices gets paid on time. So if you're exposed to France, I'd encourage you to have a look at it. And then there's also another page on the report that deals with the worst performers over the past year, which are the worst performing sectors, and they're actually quite granular. So here we can see that the share of prompt payments has decreased significantly in the insurance agents, brokers, and service industry, down by almost 15 percentage points. Agricultural production, livestock, down by 12 percentage points. And security and commodity brokers have also seen a 10 percentage point reduction in the share of prompt payments. So again, if you're a credit manager and if you want to get a rough understanding of what's happening in a country from a credit risk perspective, I'd encourage you to have a look at the Dun & Bradstreet Global Payment Study. I used to work for Dun & Bradstreet for 11 years. I always leveraged the data then. I no longer work for Dun & Bradstreet, but I still think it is an excellent piece of free of charge information. I think that is also important to say. So situation in France, not that great from a payments performance perspective, and it's also not good when we look at business failures. Here you can see the number of business failures between 1991 and 2024. And you can see, despite everyone expecting a massive increase in business failures, COVID led to the opposite. Of course, that was a temporary effect caused by support measures, caused by changes in government regulation, but you can also see that for the past 2 years, 3 years, the number of business failures has increased sharply, and it stands above that 2010 to 2019 average now as well. So that is problematic. It's not only worse than it was during COVID, that's not a surprise, but it's also worse than it was in the previous decade. There is one silver lining here, though, and that is that the annual growth rate is easing. In other words, yes, the number of business failures is still rising, but the pace of this deterioration is coming down. I try to be optimistic here. Unfortunately, that's as good as it gets. Number of business failures in France is still increasing, maybe to a smaller degree or by a smaller pace than a year ago or 2 years ago. Business to business payments performance is a problem. Macroeconomic growth is lackluster at best. And unlike in other countries, France is without a stable government. Yes, there's a president in place, obviously Emmanuel Macron, but he can't run for re-election. The far right might take over at the next presidential election. And then, things will probably become even more challenging. On that cheery note, let me sum up today's presentation and the key takeaways. Growth this year will be weak. We'll probably see some upward revisions. That's the good news in the next IMF Global Outlook forecast, but the risks are still sizable. So 2025, even if we see some upward revisions to growth in July, will still be fairly weak. Positively, the likelihood of global trade war has eased over the past few weeks, but we shouldn't forget that compared with last year, compared with 6 months ago, in fact, trade barriers are up. Certain tariffs have been brought in certain sectors for certain countries, and that is having a negative effect on international trade and is hurting these countries in particular that are very reliant on exports, such as Germany, for example, such as the Netherlands, such as Canada, and so on. Uncertainty has gone down depending on the measures you're looking at, but compared with the medium-term average, long-term average, they are still very elevated, and that has negative repercussions on both investment and consumption. UK inflation has improved in May, has come down, but it is still too high. It is still higher than in other economies, developed economies. That is reducing the likelihood for interest rate cuts. Nonetheless, I still expect interest rates to come down by 25 to 50 basis points in the second half of the year. But unfortunately, that will not have a sizable impact on credit risk. That will remain elevated. Growth is fairly slow. Lending conditions are tight. Interest rates are still very high, but maybe not as high as they were a year ago or 18 months ago, but still fairly high. And geopolitical risk is an issue as well. And when we look at France, I used the term sick man of Europe when I talked about Germany, but France is certainly in a position where the problems are very big, and I don't think the country is working on a solution. Government is fragmented. They can't agree on far-reaching reforms, and France will continue to underperform. And because of that, markets will continue to lose faith. And we can see that by looking at yields on French government debt. Of course, they have increased across the board in other markets as well, but France is certainly impacted by that as well. And I don't think that political instability will disappear anytime soon. That is quite worrying. A reminder for everyone, if you haven't done so yet, please connect with me on LinkedIn. It would be good to stay in touch. Follow Bakering on LinkedIn, because that enables you to stay informed about new report releases. We are publishing or creating many reports from the more macroeconomic country risk focused angle, as well to sectoral reports, but we also have country fact sheets that contain information about the legal requirements and the legal environment in certain countries, and all of that can be found on the Credit Hub section on bakering.global. Everything is free of charge, so if you haven't done so yet, please have a look. And a reminder, the next Real Talk Economics session is due on 6th of August, 12:30 UK time. Would be good to see you then. Have a good rest of the day. It will be very hot in Germany. I will go to the lake now because it is unbearably hot already. And I hope you are in a cool spot. And as I said, I'll see you in August. Bye-bye.